Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, July 18th. Hope you guys have a wonderful day here. We do got a couple economic news releases scheduled, and we'll start out with housing starts. So we got new construction items here for the month of June. So in May, this was actually revised a little bit lower. It was at 1.35 and got revised to 1.337 million. This is kind of tells you the annual pace of what uh, these numbers represent annual pace. So forecast for June was supposed to be at 1.3, had a huge drop down to 1.173 million. Now, on the other hand, we got for future outlook with the building permits for the month of June. So May was at 1.301 annualized pace. The forecast was supposed to be kind of in line at 1.33, and it came in again another disappointing number at 1.273 million annualized pace here. So again, housing not so good. Again, this inventory level is getting lower and lower as we see, and unfortunately, uh, that in that case, it's things are getting a little tighter and tighter. Later today, we'll get the Fed Beige Book. This will kind of give you some ideas of what's going on in different regions around the U.S. that the Fed reports on uh, in the different regions out there. And this will be released about 11 o'clock Pacific Standard Time. So unless there's any real big surprise, I don't really anticipate any changes. So today, the market is mixed. Again, we do got Fed's Powell. He's wrapping up his two-day meeting here with Congress. So yesterday he met with the Senate. Today he's meeting for the House. Don't anticipate really different as they're pretty much in line during the 2 days. So I don't really anticipate any new news. What we did basically, again, he's been pretty transparent. We basically said that they'll keep the gradual pace of rate hikes going on. So almost every 3 months it seems like. So it looks like September will probably have another rate hike, and then probably a good chance we'll have a rate hike in December. So we'll have a total of four this year. Now next year projections were about three. Uh, but again, some of the things he did indicate is that it's going to be dependent on, they will be watching the possible trade war, how that's going to affect the economy, and then also, of course, the any fiscal policies that could alter where the market is moving as well. So those things that are going to be cognizant of, and then of course they want to keep inflation to the 2% range there. Now they do see that it potentially could reach slightly above that. At some points for a temporary basis, and they don't expect to do any knee-jerk reactions to this. But again, they'll keep the current pace as going. Also, we got the Q2 earnings reports. So far, the majority have been coming in overperforming, so that's why the market has been doing pretty well. They've been pretty impressed with what they've been seeing so far, the overperformance of most of these. I think S&P so far about 88% has overperformed, which is obviously a good sign for the economy. So hopefully this will continue to move forward. Let's take a look here to see how this is rolling out into the bond market and where interest rates lie. Again, we've been in this very much sideways pattern, pretty much in the same range if you look at back end of June for about almost 3 weeks now. But we've been in this range between the 25 and 100-day moving average if you look from towards the end of May, actually. So here's the 25. Here's this is when we finally broke above the 25, and then we even reached the 100-day and got knocked down. Every time we touched 100, we got knocked down. So as you can see, the 100-day moving average is moving lower. Meanwhile, the 25-day moving average is moving up. At some point, they're going to cross. So this has been providing a pretty good floor for us. As we see, we had a slight dip here once, but for the most part, we've remained above it. As you can see, we've been kind of bouncing above it. And so as this one goes up and the 100-day moving average moves down, we're going to get squeezed there. So it's going to have to make a decision if we're going to move upwards or downwards. And as I've said before, over long term, this will probably be most likely breaking downwards below the 25-day moving average and continue. This 100-day will continue its a very strong ceiling of resistance here. So again, we got we've been in the sideways pattern here. Also on the Treasuries, we're at about 2.86. This will most likely at some point will start breaking and start rising up. As you can see, the 100-day did move up here, but the 25-day moving average is moving downwards. I think at some point we will break above that 25-day moving average, and that will become our floor of support and might give us more of a boost, and we could get back up to this level here again, this might take a little while before we get there, but I think soon you may see us breaking above this level here in the not too distant future here. All right, but right now rates again, we've been kind of at tight range, so there really hasn't been any fluctuation pricing. So pricing and interest rates are about the same as what we've seen yesterday. We're only up about 5 basis points on the mortgage-backed securities. Here we're still at 2.86. Again, there's no difference in pricing. Uh, but again, if you guys want to get more updates, just come over to Twitter, especially on the Fed Facebook, or if anything pops up, I'll be putting out on Twitter from the Fed's meeting with the House today. You can find me at Mike Bjork, and otherwise enjoy the rest of your day. Thanks so much for watching. We'll look forward to see you guys tomorrow. Bye-bye.